When the economy feels rough, when people are struggling with high grocery prices, when rent keeps climbing and layoffs are everywhere, it seems like common sense that the stock market should be suffering too. After all, if ordinary people are hurting, shouldn't businesses be hurting? Shouldn't the markets reflect the pain that's happening in real life? And yet, time after time, we see the opposite. Headlines scream about job cuts, inflation, and recession risks. But then you open a news app or turn on the TV and see the stock market hitting new highs. To someone watching from the outside, it feels almost insulting. How can Wall Street celebrate when Main Street is clearly struggling? The truth is that this confusing disconnect isn't a mistake. It's actually how the system is designed to work. The stock market and the economy are linked, but they don't move in the same way or at the same pace. If the economy is like what you feel today when you walk into a store or look at your paycheck, the stock market is more like a weather forecast. It isn't describing the present moment. It's making bets about the future. And because of that, the market can often rise when the real economy feels bad. Let's start with one of the biggest differences: time. The economy measures what's happening right now. Today's wages, today's unemployment rate, today's prices. But investors in the stock market are constantly asking a different question. Where will companies be 6 months from now? A year from now? 2 years from now? If they believe things will eventually improve, they'll start buying stocks today, even if the current headlines look grim. That's why markets often recover months before a recession officially ends. Investors don't wait until the good times arrive. They try to get ahead of them. Think about it like planning a vacation. If you book a trip to the beach for 6 months from now, you don't care if it's raining outside your window today. You're betting that the weather will be good when it's time to travel. Markets do the same thing. They're buying the future, not the present. Now, there's another twist that makes this story even stranger. Sometimes bad news for the economy can actually be good news for Wall Street. Why? Because bad news can push central banks, like the Federal Reserve, to step in and cut interest rates. Lower interest rates make borrowing cheaper for businesses and households. That encourages spending, investment, and in turn, higher stock prices. So when investors see weak job numbers or signs of slowing growth, they sometimes cheer, not because they want people to suffer, but because they expect the government to respond in a way that boosts stocks. This is where the disconnect becomes most frustrating for ordinary people. You could be facing higher credit card bills, shrinking savings, and job insecurity, while stock investors celebrate because they expect cheaper borrowing costs for corporations. In other words, the same pain that squeezes Main Street can set up a rally on Wall Street. It's not that one cancels the other out. It's that they're playing on different timelines and measuring success by different yardsticks. But let's make this even more concrete. Not all companies suffer in a weak economy. In fact, some thrive. Think of discount retailers, fast food chains, or budget airlines. When people feel poorer, they trade down from expensive products to cheaper ones. That shift can actually boost the earnings of certain businesses, which pushes their stocks higher. Tech giants sometimes rally after layoffs because investors believe cutting jobs makes the companies leaner, more profitable, and better positioned for the future. So the very same event, a round of layoffs, can mean disaster for the workers, losing their jobs while being celebrated by Wall Street as a sign of efficiency. That doesn't make it fair, but it does explain the apparent contradiction. Another important factor is psychology. Investors don't just react to numbers, they react to stories. When the news feels overwhelmingly negative, many everyday people panic, pull back, and stop investing. But professional investors, big funds, and algorithms look for moments of maximum fear. They see pessimism as a buying opportunity. Warren Buffett's famous saying captures this perfectly. Be fearful when others are greedy, and greedy when others are fearful. That's why sometimes the market surges right in, the middle of what feels like a national crisis. The fear on the ground becomes fuel for optimism in the markets. Here's a useful analogy. Imagine you're watching a movie trailer. The trailer is full of dark, depressing scenes. The hero has been defeated. The villain looks unstoppable. The city is burning. If you only watch that one moment, you'd assume the movie ends in tragedy. But you also know how stories work. The darker it looks now, the more likely a turnaround is coming later. Investors think about the economy in a similar way. Even if today looks bleak, they're betting the future will include a recovery, and they want to buy tickets early. Of course, the market doesn't always get it right. Sometimes it's overly optimistic and rallies too soon, only to fall again when the the recovery doesn't materialize. Other times, it stays negative even when the economy begins to heal. But in general, the stock market is less about how you feel. At the grocery store this week and more, about how big investors think companies will perform a year from now. So what does this all mean for you, watching at home? First, it's important not to confuse your personal financial situation with the movement of the market. If you're struggling with bills, high rent, or job insecurity, that pain is real, and the stock market doesn't take it away. But the market is measuring something different. It's measuring expectations of corporate profits, interest rates, and global trade. They overlap, but they are not the same thing. Second, if you're an investor, it's a reminder that timing the market based on headlines is incredibly difficult. The news may look terrible, but by the time it feels bad for you, the market has already priced it in. And by the time it feels better in your everyday life, the market may already have moved on. That's why long-term investors focus less on reacting to daily news and more on consistent strategy. Third, this disconnect is a good reminder of why so many people feel frustrated with the financial system. When workers see their jobs cut, their wages stagnating, or their debt increasing, while stock charts are soaring, it can feel like a parallel universe. And in some ways, it is. The market isn't designed to reflect fairness. It's designed to reflect profit expectation. That gap explains why many people don't trust Wall Street, even when their retirement accounts are tied to it. To make this relatable, think about your own household budget. If you're cutting back on groceries and delaying purchases, you might feel poorer. But imagine you also get a letter from your bank saying your mortgage interest rate is dropping. Suddenly, even though things feel tough today, you know you'll have more breathing room in the future. That's how the market thinks. It reacts not to the current squeeze, but to the prospect of relief ahead. So the next time you see a headline about the market soaring while the economy feels weak, remember that you're looking at two different timelines. One is the lived experience of millions of people right now. The other is a prediction machine, constantly trying to price in what happens next. They intersect, but they rarely move in lockstep. It's tempting to feel cynical, to say the system is broken or rigged. And in many ways, the system is tilted toward investors and corporations. But understanding the mechanics gives you power. It helps you see why the stories you hear don't always match what you feel. And it helps you make better decisions for your own money, whether that's investing for the long term, budgeting for the short term, or simply recognizing that the headlines about Wall Street don't necessarily reflect the reality of your own wallet. At the end of the day, the disconnect between the economy and the stock market isn't a bug. It's a feature of how financial markets operate. They're not here to tell you how life feels on the ground. They're here to price in what they think happens next. Sometimes that prediction is wrong, but more often than not, it explains why markets can celebrate even when the real world feels painful. And that brings us back to the original question. How can the stock market rise when the economy feels bad? Because the market isn't watching today, it's watching tomorrow. It's reacting to interest rates, corporate profits, and investor psychology. It's responding to a movie trailer that hasn't played out yet. For better or worse, that's how the system works. And understanding it, seeing the difference between your daily reality and Wall Street's future bets, is the first step in navigating your own financial journey with a little more clarity and a little less confusion.